1934 and for other purposes.
The question is, will the House suspend the rules and pass the bill as amended? Members will record their votes by electronic device. This is a 5-minute vote.
One of the bills debated earlier dealing with altering part of the 2010 Dodd-Frank financial regulations law. 5-minute vote. One more 5-minute vote will follow, and then they will move on to general debate on the bill dealing with financial swaps. Later on today, general debate on the defense authorization bill for 2014. Meanwhile, debate continues in the Senate on the immigration and border security bill. A snapshot of where things are today from a Capitol Hill reporter. Roll calls. Meredith Shiner is covering the Senate debate on immigration. What can you tell us about the bill in terms of the key amendments we should be watching for?
So I think that right now everything will be about the amendments that are coming up, because you had a very overwhelmingly bipartisan vote to open debate on this bill. You had 85 senators vote in favor for it. The only 15 who didn't vote for it were actually all Republicans. And so you're going to see a lot of votes on particular issues that either cater to the right or to the left, and it's going to be this very delicate dance of which amendments can you pass to make the bill more suitable for Republicans potentially to vote for a final package, and how many of those amendments can you do before you alienate people on the Democratic side. So the big issue on this is actually border security. You have even Marco Rubio, who's a member of the negotiating Gang of Eight that built the framework that's on the floor now, saying that we do need measures to enhance the border security provisions of this bill. You have Senator Cornyn, who has introduced a provision on this, and Senate Majority Leader Harry Reid has already said that this would be a poison pill. So it's going to be a lot of back and forth rhetorically, but I think in general, if you've been here for these big legislative debates, whether it was on health care or Dodd-Frank, this seems a lot less dramatic and intense. It just sort of seems like this inevitable conclusion in the Senate. But even then, it's all a matter of what will happen in the House. So the other debate is how many votes do you need for this bill in order to make it politically viable? Procedure indicates that you would need 60 to break a filibuster on the motion to close debate. However, you have some senators, including Chuck Schumer, who is again one of those lead negotiators on that group of 8, saying that they should have at least 70 in order to put more political pressure on the House.
What are you hearing about the Gang of Eight in terms of what they're doing to ensure that the amendment process moves along smoothly?
Well, again, they've been talking about regular order since the beginning. If you looked at the Senate Judiciary Committee, which was the committee that officially marked up this bill that's on the floor now, I mean, they considered more than 200 amendments, and there were 300 amendments that were filed. So they've been very good about hearing senators' cases, even on votes that don't look like they're destined to succeed. So an example of this, and something I had meant to say in my earlier answer, was Pat Leahy, who is the Senate Judiciary Chairman, had wanted to vote in committee on a provision that would have expanded some of the rights guaranteed by the bill to members of the gay community, specifically providing green cards to the spouses or partners of American citizens who are foreign-born. So, you know, when you're in this country and you marry someone who's foreign-born, they can become an American citizen. That isn't the case for someone who is gay or lesbian. So that was a provision he wanted to vote in committee, but pulled it because he thought maybe it would, or he was told at least by both Democrats and Republicans, that it would disrupt this delicate balance on the bill. So you have Democrats in that situation, like Chuck Schumer and Dick Durbin, who would ordinarily support gay rights, saying, no, we can't bring this amendment to this bill because it might tank the larger effort on it. So particularly because they have such a stake in this, these 8 members who have spent so much time negotiating this bill, they're very careful about wanting to try to control the amendment debate. The question is just whether they can. And I think this is particularly risky for Republicans. Lindsey Graham, another member, for example, he's in cycle. He's up for re-election in South Carolina this year, and he's put a lot of political capital into this. And you don't want it, if you are involved in this bill, you don't want that effort to be undercut by amendments that could make it unpalatable for others to vote on. You mentioned the potential number of votes needed. What about the timetable that Senator Harry Reid set? What date are we looking for? They want this debate to wrap up before July 4th recess, so within the next 3 weeks.
You also briefly mentioned the U.S. House. Where are they in terms of their legislation, and don't they also have a similar Gang of Eight in the House side?
It's funny because the reports you read coming out of the House are much more, what's the word for it? I don't know. They're almost bipolar at this point. And the reports you get, one day they're making all this progress, the next they're totally stalled. One day they have 8 members, the next they have 7. The Speaker of the House, John Boehner, has said that he'd like a bill to come to committee within the next few weeks. Whether or not they can do that, I don't know, but they're going to have to try to put a bill on the floor because the amount of pressure that will be on the House and the Republican Party, particularly if the Senate can approve their bill, to get something to send to be able to conference or to negotiate further. They need a negotiating position, and right now they don't have one. So if there's any sort of will to do any sort of legislation, they're going to need to come up with something to come to the table with the Senate on.
Meredith Shiner is covering the immigration debate on Capitol Hill for CQ Roll Call, and you can read her reporting at rollcall.com. Thanks for joining us.
Thanks for having me.
On this vote, the yeas are 411, the nays are 12. 2/3 being in the affirmative, the rules are suspended, the bill is passed, and without objection, the motion to reconsider is laid on the table. The unfinished business is the vote on the motion of the gentleman from Arkansas, Mr. Crawford, to suspend the rules and pass H.R. 742, on which the yeas and nays are ordered. The clerk will report the title of the bill.
Union Calendar number 75, H.R. 742, a bill to amend the Securities Exchange Act of 1934 and the Commodity Exchange Act to repeal the indemnification requirements for regulatory authorities to obtain access to swap data required to be provided by swaps entities under such acts.
The question is, will the House suspend the rules and pass the bill? Members will record their vote by electronic device. This will be a 5-minute vote.
It's the last vote in this series. The bill deals with financial swap data. And after this series of votes, we expect the House to move on to general debate on a bill that would direct federal financial regulators to issue rules regarding swap transactions between the U.S. and foreign countries. This is a 5-minute vote. Also, after that general debate later on today, the House will take up the fiscal year 2014 Defense Authorization Bill. For preview of that debate, we spoke to a Capitol Hill reporter.
Herb, staff writer at The Hill. House lawmakers plan to spend their work week on a bill reauthorizing programs at the Defense Department. What are some of the key issues coming up in the debate?
There are a lot of big issues. Probably the biggest is going to be the fight over sexual assault in the military and how the problem should be addressed to curb the number of assaults that have occurred over the past year. Congresswoman Jackie Speer has been pushing in committee, and she wanted to take the decision to prosecute cases away from military commanders. That was rejected by the Armed Services Chairman, Buck McKeon, and so it's not in the bill. And I think that's going to be one of your major flashpoints. There's also going to be fights over the war in Afghanistan, over a new East Coast missile site, and the total funding level of the bill as well, as the bill is $52 billion above the cap set by sequester.
So you mentioned those spending levels and the budget caps. They're under the sequester. How do the leaders justify changing that?
Well, it's interesting because the Pentagon itself submitted a budget for 2014 that was $52 billion over, and then the House budget and the Senate budget that passed also kept it at the higher levels. What Armed Services leaders on the House side say is that they want this funding. They don't want sequester, and so by legislating to a lower level, they would be, in their estimation anyway, encouraging the sequester to take effect. And so they say there still is time to try and stop sequester in 2014 even though there's no momentum right now on the Hill to actually do away with the cuts.
What does the bill say about House Republicans' priorities?
Well, I think particularly missile defense is a big one that they're pushing this year. They want to establish a new site on the East Coast for ground-based interceptors to try and guard against future threats against Iran. The Armed Services Committee put $140 million for the 2014 budget in that bill. You're going to see attempts this week, as we saw last week in committee, for Democrats to strip that out. That is probably the biggest partisan issue. Republicans have also, put a step forward on the importance of dealing with sexual assault. McKeon, the chairman of the committee, signed off on the changes that were made. And you also saw an increase of $5 billion to the amount of spending for the war in Afghanistan. And that money is going to readiness accounts that were hurt because of sequester this past year.
What are Pentagon officials saying about the bill?
Pentagon officials, I think, have generally been supported. There have been complaints because they tried to cut costs through a new round of base closures, new health care fees for the military health care, and making a smaller raise for troops last year. And the Armed Services Committee rejected all of those. They say that it's not fair, and they disagree with the Pentagon on the usefulness of base closures. The administration has put out its statement of policy and is threatening to veto the bill. It frequently does that, at least over the past few years, particularly over detainee issues in Guantanamo, which is a new priority now for the president. The bill, as passed by the Republicans, bars the president from moving any detainees from Guantanamo to U.S. soil.
And on the other side of the Capitol, how's the Senate bill shaping up?
This week, the Senate Armed Services Committee is marking up their bill. It's a little different process because the Senate markup for the full committee is mostly done in a closed session, whereas the House committee was here until 2:15 in the morning doing their markup. The Senate is opening up one section on sexual assault, where you're going to see a proposal from Senator Gillibrand talked about. She's trying to take the decision to prosecute cases away from commanders. Carl Levin, the senator who's the chairman of the committee, does not agree with that, and he instead is establishing, or is seeking in the bill to establish a review process for when commanders don't prosecute the cases.
Jeremy Herb is a staff writer at The Hill. Appreciate your time.
Thank you.
On this vote, the yeas are 420, the nays are 2. Two-thirds being in the affirmative, the rules are suspended, the bill is passed, and without objection, the motion to reconsider is laid on the table. The House will come to order. For what purpose does the gentleman from Texas seek recognition?
Mr. Speaker, pursuant to House Resolution 256, I now call up H.R. 1256, the Swap Jurisdiction Certainty Act.
The clerk will report the title of the bill.
Union Calendar number 72, H.R. 1256, a bill to direct the Securities and Exchange Commission and the Commodity Futures Trading Commission to jointly adopt rules setting forth the application to cross-border swaps transactions of certain provisions relating to swaps that were enacted as part of the Dodd-Frank Wall Street Reform and Consumer
Mr. Speaker, the House is not in order.
Pursuant to House Resolution 256, the amendments recommended by the Committee on Financial Services printed in the bill are adopted. The bill as amended is considered read. Debate shall not exceed 1 hour, with 40 minutes equally divided and controlled by the chair and ranking minority member of the Committee on Financial Services, and 20 minutes equally divided and controlled by the chair and ranking minority member of the Committee of Agriculture. The gentleman from Texas, Mr. Henserling, and the gentlewoman from California, Ms. Waters, will each control 20 minutes. The gentleman from Oklahoma, Mr. Lucas, and the gentleman from Minnesota, Mr. Peterson, each will control 10 minutes. The chair recognizes the gentleman from Texas.
Mr. Speaker, I ask unanimous consent that all members have 5 legislative days within which to revise and extend their remarks and submit extraneous material for the record on H.R. 1256 currently under consideration.
Without objection, so ordered.
Mr. Speaker, I recognize myself for as much time as I may consume.
The gentleman is recognized.
Mr. Speaker, the legislation before the House this afternoon, H.R. 1256, the Swap Jurisdiction Certainty Act, is a bipartisan response to what many view to be, frankly, regulatory red tape overreach and the adverse consequences that it can have on the millions of our fellow countrymen who are either unemployed or underemployed. The impact that it could have on the competitiveness of our U.S. employers and job creators. Mr. Speaker, I need not tell anyone in this body that we are regrettably and continue to be in the middle of a non-recovery recovery. If it wasn't for the fact that so many people have actually left the job force, the working participation rate, our unemployment rate would be even higher. Many have just given up. We know that for many, even though America has in the past produced 3.5% economic growth and is probably capable of 4 or 5% economic growth with the right economic policies, regrettably we find ourselves mired in 1.5 to 2% GDP growth, which means, Mr. Speaker, a lot of American dreams go unfulfilled, and a lot of our constituents lay awake at night wondering how are they going to pay the bills. So, Mr. Speaker, jobs continue to be job number 1, I believe, of the United States House of Representatives. But regrettably, those who create jobs, those who employ our constituents, are drowning in a sea of red tape. There has been an over 50% increase of the Mr. Speaker, the House is not in order.
Will members please take their conversations off of the House floor? Gentleman from Texas.
Mr. Speaker, there has been over 50% increase in regulations under the Obama administration. We know that is directly correlated to the lackluster economic growth that we see in the nation today. I still vividly remember that one small business person in East Texas came up to me at a small cabinetry shop, and even though it was still profitable, he shut it down. And he shut it down because of the red tape burden that crushed him and the jobs of 17 people who worked in East Texas, and he said, "Congressman, it got to the point where I just thought my federal government didn't want me to succeed." And so, Mr. Speaker, we always have to be vigilant in ensuring that the red tape burden doesn't strangle the jobs and hopes and aspirations of the American people. So that brings us to H.R. 1256, the Swap Jurisdiction Certainty Act. Now, many who may be tuning in this debate may not be quite familiar with the world of derivatives, but it's a way that many farmers, ranchers, manufacturers hedge risk in order to become successful companies and employ people and sell their goods and services at competitive prices. An outfit like John Deere will use a derivative. They may do an interest rate swap as they finance a tractor for some farmer in rural East Texas that I may represent. And so that derivative is directly linked to the cost and the availability of that tractor. And what we're trying to do with H.R. 1256 is make sure that those who are trying to access derivatives to hedge risk, to create and sustain jobs, don't automatically overnight have huge swaths of the global market pulled out from under them. Because if they do, all of a sudden, it could be that somebody can't finance that tractor anymore. Companies like Southwest Airlines that operate in my hometown of Dallas, Texas, they hedge their fuel cost. And if they can't access global markets, who knows about the success of their hedges? And then all of a sudden, the price of a trip for grandparents to fly in from Kansas City to see their grandkids in Dallas, Texas just became more prohibitive. It just became more expensive. An outfit like Coors, they'll hedge their aluminum cost through swaps, maybe their wheat cost through swaps. And I don't know about other members, but I represent a lot of hard-working people in the 5th District of Texas. And let me tell you, sometimes on a hot August afternoon, after working, putting in the 40 hours at the Pepsi bottling plant, or maybe putting it in at some of the other factories that we may have in Mesquite, you know, somebody might just want to go to the 7-Eleven and buy a six-pack. And in America, that ought to be their right. And the inability to access global markets for swaps ultimately can actually inflate that cost. And that's not something I care to deny to hardworking Americans who want that. So this is a very simple and bipartisan bill. Mr. Speaker, this passed. We had a hearing in the Financial Services Committee. We had a markup in the Financial Services Committee. It passed with 100% of the Republican vote. It passed with almost 2/3 of the Democratic vote. You would think that we might be under the suspension calendar for this one, but in order to respect the wishes of the ranking member, we are having a more prolonged debate in addition to the one that we've already had in the committee. But, Mr. Speaker, ultimately this bill will do two things. It will tell the Securities and Exchange Commission and the Commodities Futures Trading Commission, you need to issue one joint rule when it comes really to American end users being able to access global markets. Not one suggestion and one rule, two different rules. One rule. One rule. Let's take down a little complexity here. And, Mr. Speaker, after Dodd-Frank, we're about to celebrate its 3rd anniversary next month. After 3 years of deliberating, maybe it's time to actually come out with a rule and create a little certainty for the people at Coors and at Southwest Airlines and at all the other employers in John Deere. Maybe it's time to create a little certainty. And so the bill says, okay, let's get this done in 9 months. You've had almost 3 years. It's time to get it done. And last but not least, it says, in order not to pull the rug out from under these people on day one, it says, you know what, the 9 largest markets, we are going to have a presumption that their regimes are broadly equivalent to the U.S. and not immediately deny access. Now, at any given time, if the CFTC and SEC come to the conclusion that these regimes are not broadly equivalent, that somehow they present risk to our economy, with the stroke of a pen, they can change that presumption, but not on day one. Not on day one, Mr. Speaker. So for the sake of economic growth, for the sake of jobs, to provide some certainty in a struggling economy, I would urge all of my colleagues to support this bipartisan legislation that was voice voted in the Ag Committee, voice voted, and had unanimous consent of all Republicans and almost two-thirds of the Democrats on the Financial Services Committee. I urge all my colleagues to support H.R. 1256. I reserve the balance of my time.
Gentleman from Texas reserves. The gentlewoman from California is recognized.
Mr. Speaker, I yield myself such time as I may consume.
Gentlewoman is recognized.
Thank you very much. Mr. Speaker and members, I'd like to try and clear up some of the misunderstandings of what this bill is about. The more we debate it, the better members understand the impact of this bill on our economy. The gentleman from Texas, the chairman, just talked about how generous they are in allowing this debate to take place. Members, let me tell you what really happened. The fact of the matter is there's been an attempt to hide H.R. 1256 in this DOD bill. What business does it have in this bill? Why is it the Rules Committee determined that it would be a closed rule? The first reason is that they tried to get away without having amendments to the bill. I had an amendment that I'd offered in committee that was not accepted, an amendment that if there was an open rule, I would have been able to offer this amendment on the floor, but no, they close-ruled this bill to keep any amendments from being heard, to be debated, to be voted on, because they know that if members really discover what these derivatives are all about and how they could create such risk that we'll be put in the position of bailing out failed institutions all over again, that members would not support this kind of bill. This country has been through a terrible financial crisis. Part of the reason is that we allowed our banks and financial institutions to place unregulated bets on the mortgage markets. Remember AIG? What did AIG do? It made a really big bet that the mortgage market would go up, and it lost. And the taxpayer was put in the position of having to bail it out. The Dodd-Frank Act enabled us to put a stop to that kind of betting going on, hidden from the rest of us, finally dragging that activity out into the sunlight. The CFTC and the SEC are finally putting in place rules of the road to prevent any one institution from threatening our livelihood again. But this bill wants to drag some of that activity back into the shadows, allowing banks and others once again to enter into transactions without even our regulators being able to see them. You may say that this bill just concerns the limits on how far U.S. law goes. So why is it so important that the CFTC and SEC have discretion over the rules on cross-border initiatives? Because the exposure that a foreign branch or subsidiary of a U.S. institution takes in foreign markets comes back home to the U.S. Moreover, U.S. banks and corporations may find that those they do business with have much more hidden exposure because of foreign transactions. This bill says that we will have to rely on the foreign regulators to protect us. We shouldn't have to rely on foreign regulators who don't even have regulatory regimes to protect us. We should protect ourselves by making sure that anybody that our branches and our subsidiaries are doing business with have comparable rules. Those countries must have comparable rules to the U.S. rules in order to protect us. To put it simply, this bill would delay implementation of the Wall Street Reform Act's derivatives provisions by months, if not years, and preserve the kind of opacity in our markets that led to taxpayers bailing out AIG just 5 short years ago. For example, while Europe has made considerable progress on its swaps, clearing and reporting rules, Europe's framework for implementing trading and internal business conduct standards have been caught up in delays. It is unclear at this point how strong those requirements ultimately will be. This bill increases the incentives for other jurisdictions to avoid making the tough decisions to put in a strong financial framework. I'll reserve the balance of my time.
Gentlewoman from California reserves. The chair will remind all persons in the gallery that they are here as guests of the House and that any manifestation of approval or disapproval of the proceedings or other audible conversation is in violation of the rules of the House. Gentleman from Texas is recognized.
I'll yield myself 30 seconds just to say to the gentlelady that she had the opportunity to offer her amendment in committee, and her amendment was defeated. Second of all, as she raises the specter of bailout, she has also said before that Dodd-Frank ended bailouts, so I don't know which it is. I would also say nothing in the bill changes the rulemaking authority of the CFTC or SEC, and it delays nothing, but it was just 6 months ago that the ranking member sent a letter to the chairman of the CFTC, quote, I request that you provide for phased-in compliance and appropriate short-term relief from relevant Title VII provisions, so she herself was asking for a delay. I now yield 5 minutes to the gentleman from New Jersey, the chairman of the Subcommittee on Capital Markets and Government-Sponsored Enterprises and the author of this legislation.
Gentleman from New Jersey is recognized for 5 minutes.
And I thank the Speaker, and I thank the gentleman from Texas for yielding. And I also want to thank the gentleman from Delaware, Mr. Carney, and the gentleman also from Texas, Mr. Conaway, and the gentleman from Georgia, Mr. Scott, who all along with us were able to work together in a bipartisan manner on this legislation. So I want to begin my comments then today by clearing up what might be called a knee-jerk reaction that some commentators have made about our efforts on this legislation. See, today's legislation are not about deregulating the swap markets or creating loopholes for market participants. In fact, this bill is just the opposite of that. See, there is broad bipartisan, I'll say it again, bipartisan support for appropriately regulating the swap markets and shining the proverbial light of day, if you will, on what was once an opaque marketplace. And I agree that bringing greater additional transparency and clarity to this market is a positive thing for all, for American consumers and taxpayers as well. But I have significant concerns about how the ongoing Dodd-Frank implementation of this appropriate regulation is being conducted. See, only in Washington, D.C. would you have two, not one, but two regulatory bodies tasked to work together to implement rules required by Congress, and then have them working down two separate, entirely different tracks on rules that will impact literally hundreds of American businesses and thousands of investors. See, what you have is one agency over here, it's moving forward with a 100-page informal guidance. And the other, on the other hand, has just released a 1,000-page formal rule proposal. One proposes applies U.S. regulations to transactions taking place entirely outside of the U.S. between U.S. non-persons, and the other creates a new detailed substitute compliance framework. So it's hard to imagine a scenario in which these two proposals are more different. In effect, we have two very powerful U.S. regulators. Both of them have literally hundreds upon hundreds of millions of dollars in budget and thousands of staff. But at the end of the day, they cannot sit down together and work out a common proposal. That's not what Dodd-Frank wanted them to do. They wanted them to come together, and that's what this legislation would effectuate. H.R. 1256, the Swaps Jurisdictionary Certainty Act, will restore that much-needed sanity to the rule writing of this extraterritorial application of U.S. swaps regulation. Again, given that there has been some confusion and a great deal of mischaracterization by some commentators on the impact of this legislation, let me take a moment to make certain everyone understands exactly what it does and the effects it will have. See, the legislation before us allows the CFTC and the SEC to continue to enjoy significant discretion and also flexibility as to how they implement the rules. We are not removing any of their current authority. In fact, we're adding to it and we're enhancing it. First and foremost, the legislation specifically requires the SEC and the CFTC to have the same or identical cross-border rules. You know, I think it's difficult, maybe it's impossible, for anyone to suggest that it is appropriate for two domestic U.S. regulatory bodies to have two different standards governing very similar parts of the market. So by simply requiring the agencies to get together and have identical rules, the bill will limit the ability for potential arbitrage opportunities for the market participants, and it will ensure that we have a standard, identical regulatory regimes for both types of swaps. See, there is a great deal of ongoing discussion right now about how to limit this, how to limit regulatory arbitrage opportunities for market participants. Under this new regime, the most glaring area of potential in this area is if the SEC and the CFTC has different rules. Secondly, the legislation requires a formal rule, not a guidance, but a formal rule to be issued. Currently, the CFTC is moving down the path of instituting a more amorphous guidance, if you will, which really has questionable legal authority. So without a formal rule in place that carries the force of law, there is a valid concern that some entities won't feel the need to even abide by this guidance from the CFTC, or that, if it's challenged by court, might carry considerably less weight. So by requiring a formal rule, the bill will then ensure that the force of law will apply without question. And finally, the legislation specifically authorizes the SEC and the CFTC to regulate swap transactions between U.S. and foreign entities. Now, this is important. If the regulators are concerned about the importance of the importation of systemic risk. Why is this important? Because under current law, it is really questionable what authority these agencies actually have to regulate potential transactions between U.S. and foreign participants. We add this to it and give them that explicit authority. So if the regulators are concerned about any foreign country not living up to the Obama administration's G20 commitments, that was established back in 2009, then these regulators will be able to work together to specifically authorize under the Act. This expansion and enhancement, if you will, of the regulators' current authority, I would think, it should be, well received by the administration. If I can have just about another 45 seconds. Great.
Gentleman is recognized.
And so finally, in the formal statement of administrative policy, the administration argues that the bill will somehow slow down the implementation of Title VII. This can't be further from the truth. By requiring the agencies to work together and put the same rule, this will remove legal obstacles here in Washington, ensure that we have the appropriate regulatory framework, and sooner rather than later. It will remind the people saying that we will somehow slow down implementation of these rules. No, that could not be further from the truth. Dodd-Frank was passed almost 3 years ago, and we're no closer today than we were 3 years ago to getting this done. Mr. Speaker, let us restore then some common sense and some clarity to the rulemaking process and actually bring some additional transparency. Let us not play into the narrative that the rest of the country has a dysfunctional Washington. Let us make sure that our financial regulators are actually working together and not instead trying to allow some to front-end each other. And let us pass this legislation. And with that, I yield back.
The gentleman's time has expired. The gentleman from Texas reserves. The gentlewoman from California is recognized.
Unanimous consent to enter into records 3 letters of opposition to this bill. One from the Executive Office of the President of the United States, Office of Management and Budget, Americans for Financial Reform, and American Federation of Labor and Congress of Industrial Organizations.
Without
and
objection,
I yield to the gentlelady from New York 2 minutes.
The gentlelady from New York is recognized for 2 minutes.
I thank the gentlelady for yielding and for her leadership. Mr. Chairman, I rise today in opposition to H.R. 1256, the Swap Jurisdiction Certainty Act. I oppose this bill, as does the Obama administration, because it would fundamentally undermine Dodd-Frank's derivatives reforms and would create a loophole big enough to drive a AIG truck through. Many of the derivatives that brought down AIG in 2008 were executed through one of its foreign branches, and many of the counterparties on those derivatives were European banks. These derivatives were a big factor in the AIG bailout that cost our taxpayers $182 billion, and in the financial crisis that cost our economy well over $12 trillion. H.R. 1256 would require the CFTC and the SEC to issue a joint rule detailing how U.S. derivatives rules would apply to transactions between U.S. and foreign companies or individuals. However, the bill then requires the agencies to exempt foreign companies from U.S. rules unless both agencies determine that the derivatives rules in the foreign country are broadly equivalent to U.S. rules, a vague standard that would weaken both the CFTC and the SEC's proposed rules governing cross-border transactions. In the modern financial system, risk knows no borders. Problems in a U.S. bank's foreign office flow right back to the parent company here in the U.S., and it is the U.S. parent company that ultimately bears the loss. This is especially true in derivatives, which are traded in a global and highly interconnected market. For these derivatives to be truly effective, however, they must cover derivatives executed in the foreign branches and guaranteed affiliates of the U.S. banks.
Gentlelady's time has expired.
Okay. I urge my colleagues to vote against this bill.
Gentlewoman from California reserves. The gentleman from Texas is recognized.
Mr. Speaker, I now yield 2 minutes to the gentleman from Texas, Mr. Nagelbauer, Chairman of the Housing and Insurance Subcommittee.
Gentleman from Texas is recognized for 2 minutes.
Thank you, Mr. Chairman, and I want to rise in support of H.R. 1256. You know, one of the things that people, I think, demand out of their government is transparency and regular order. And one of the things about this bill is there's been a lot of transparency and a lot of debate and discussion about it. In fact, it was marked up in the previous Congress, both in the House Agriculture Committee and the House Financial Services Committee, and you would have thought we would have just brought that bill back here and put it on suspension, but that's not what's happened. It was sent back to the House Financial Services Committee. It was sent back to the House Agriculture Committee, and in fact, during that process in the Financial Services Committee, some issues that Mr. Frank, the ranking member last year, brought up, and it was incorporated into this markup. When it was over in the House Ag Committee, which I have the opportunity to sit on both of those committees, some changes that were recommended by the ranking member, Colin Peterson, were incorporated into that bill, and in fact, that bill passed on voice vote in the House Agriculture Committee. Mr. Kildee offered some language that would limit the bill to the 9 largest swap jurisdictions, as was alluded to earlier. Those were incorporated into this bill. The ranking member of the full committee did bring up an amendment, and interestingly enough, some of her own members did not support that amendment. So I would say about H.R. 1256 is that it's going to bring some certainty to a very uncertain process. The fact that it's been 3 years and these two agencies have not been able to come together and come out with a common rule, and it doesn't make sense. And I think it's one of the things that frustrates people about government is that two different agencies would have different rules about the same thing. And then I think the third thing, too, and it was alluded to by the chairman, is that these are important markets to our businesses, whether they be large or small. And they rely on foreign participants to come into the markets and provide opportunities to hedge, whether it's crops or ingredients into a manufacturing process. And so basically what we're doing is we're saying that the SEC and the CFTC still have the authority that was given to them in the original Dodd-Frank bill, but we need some harmonization not only within those agencies but with the other countries that are involved regulating these foreign entities as well. And with that, I yield back my time.
The gentleman's time's expired. The gentleman from Texas reserves. The gentlewoman from California is
I'd
recognized.
like to enter into the records the amendment that I would have offered had they not come up with a closed rule. And I yield to the gentleman from Massachusetts, 1 minute and a half.
The gentleman from Massachusetts is recognized for 1.5 minutes.
Thank you, Mr. Speaker, and I thank the gentleman for yielding. Look, this bill is not going to create jobs in America. This bill is all about foreign swaps. If we're going to create jobs, we're going to create them in foreign countries. By the way, Dodd-Frank exempts foreign swaps activities from derivatives regs, except when they have, and this is a quote from the bill, direct and significant connection with activities in or effect on commerce of the United States. Other than that, if they don't affect us, they're not subject to regulation. Simple. But if they're done in a foreign country and they affect us, if it's just a way to get around our regs, they're subject to United States regulation. Really kind of simple. And by the way, according to the Wall Street Journal, the 6 largest banks of the United States combined have 22,621 subsidiaries. That's an average of 3,770 subsidiaries each. Why? In order to get around this kind of regulation. I don't blame them. I'm not against swaps. I'm not against swaps conducted on foreign soil. I simply want them subjected to United States regulation. I don't think it's that difficult. I don't understand why we have to do this, except to say, here's a big open door. This is a huge hole to the regulatory process of the United States of America. I understand that some members of this body don't like any regulation, and I respect that. But get up and say it.
Gentlewoman from California reserves. Gentleman from Texas is recognized.
Mr. Speaker, may I inquire how much time remains on both sides?
Gentleman from Texas has 3 1/4 minutes. The gentlewoman from California has 12 minutes.
I'm sorry, has how many?
12 minutes.
At this time, Mr. Speaker, I will yield 2 minutes to the gentleman from Florida, Mr. Crenshaw.
Gentleman from Florida is recognized for 2 minutes.
Well, I thank the gentleman from Yield, and you know, this seems to be one of the most straightforward, common-sense pieces of legislation I've seen in a long time. And as chairman of the subcommittee of appropriations that oversees the budget of the SEC, we have hearings from time to time to make sure that the SEC is doing their job, that is to protect investors, to make sure that capital markets are fair and stable. And here we have a situation where a certain amount of instability has been created because you have 2 different agencies that are writing different rules about what's called the over-the-counter commodities market. And that's a global market. It's very important to an awful lot of people. And it seems to me that if we're going to have that kind of regulation, you would think that the SEC would coordinate with the other agency, the Commodities Future Trading Commission, and they would publish one rule that people could understand and live by. But that's not the case. You don't have the similarity that you need. You don't have them mirroring each other. And all this bill does is simply say, look, if we're going to ask for this kind of regulation, let's make sure that these 2 agencies publish the same rule. Otherwise, you've got all kinds of uncertainty, all kinds of turmoil. And if you're a regulated individual or company or entity, how do you know what to comply with unless this happens? Now, I don't want to have to put language in the appropriations bill to kind of encourage folks to do that. It's simple, just pass this bill. And it sounds to me like we're going to. It's a bipartisan bill, and I just encourage everyone to vote yes and move on. I yield back my time.
Gentleman yields back. The gentleman from Texas reserves. The gentlewoman from California is recognized.
I yield a 1.5 minutes to the gentleman from Massachusetts.
The gentleman from Massachusetts is recognized for 1 minute and 30 seconds.
Thank you, Mr. Speaker. Thank the gentlelady for yielding.
Thank you.
I rise today in strong opposition of the bill before this House today, H.R. 1256, the Swaps Jurisdiction Certainty Act. It should be called the Wall Street Bailout Certainty Act because that's the actual effect this is going to have. It'll do serious and irrevocable harm to our efforts to rein in the reckless behavior of Wall Street. In the words of our own Commodities Future Trading Commissioner, Chairman Gary Gensler, this bill will blow a hole in the hard-fought derivatives reforms we passed 3 years ago. Section 722 of the Dodd-Frank Act gives the CFTC authority to regulate overseas derivatives activities that have a direct and significant effect on the commerce of the United States. If my colleagues need an example, I just hearken to the ranking member's example of why this cross-border authority is so critically important, and that was the case of AIG, the insurance giant. AIG engaged in increasingly complex and risky derivatives bets on subprime mortgage market out of its AIG Financial Products subsidiary in London. And because there was virtually no oversight of derivatives markets, AIG Financial Products was able to deal in the shadows. And when the housing bubble burst, no one, not its directors, not its counterparties, not even its regulators, knew just how deeply in trouble AIG was. So while we have adopted a number of regulations within Dodd-Frank, this bill will allow all of the companies that would be regulated to escape that regulation by doing these derivative deals through their foreign subsidiaries. And the 4 biggest derivatives dealers in this country have over 3,000 foreign subsidiaries each. So this is an escape hatch for them. And
Gentleman from Texas.
I yield back. Thank you. Vote no on this bill. Thank you.
Reserve. Gentleman reserved. Gentlelady from California.
I yield a minute and a half to the gentleman from Texas. Mr. Green.
Gentleman from Texas is recognized for 1 1/2 minutes.
Thank you, Mr. Speaker. Mr. Speaker, the question before us is whether we will outsource American economic stability in this quadrillion-dollar derivatives market to foreign subsidiaries of American companies. Will we outsource in this quadrillion-dollar market? Now, a quadrillion is a big number. If you stack dollar bills one on the other, a quadrillion would take you all the way from the earth to the sun. It's important for us to remember that AIG outsourced to a foreign subsidiary. It was in London. And of course, we know what happened with AIG. Finally, I will say this. We're trying to jumpstart the economy, it seems. We have to be careful what we do when we try these jump starts, because this derivatives market has within it interest rate derivatives. These derivatives, if there's a spike in interest rates, can have an enormous impact on the world economy. So let us be careful as we jumpstart. Sometimes when we do common things like jump-starting our cars, it works fine. But on other occasions, we can have an explosion. Let's be careful as we jumpstart the derivatives market. I yield back.
Gentleman from Texas, continue to reserve.
Continue to reserve.
Gentleman reserves. Gentlelady from California.
I yield to the gentleman from Minnesota 1.5, minute and a half.
Gentleman from Minnesota is recognized for 90 seconds.
Mr. Speaker, I'll get right to the point. AIG, Citibank, Lehman are recent examples of institutions where the U.S. parent was hurt by those firms' problems abroad. Lehman had 3,300 subsidiaries at the time they declared bankruptcy, and its London subsidiary had 130,000 outstanding swap contracts, many of them guaranteed by Lehman Brothers Holdings, headquartered in the U.S. Bank of America, for example, has more than 2,000 subsidiaries, with 38 of them in foreign jurisdictions. Bank of America's books its derivatives not only in the U.S. but also in the U.K. and in Ireland. Now, the very simple fact, Mr. Speaker, is that Dodd-Frank, the bill that has been deconstructed before our very eyes while the ink is still wet on the page, requires that all foreign and U.S. firms transacting with U.S. persons comply with derivatives market reform. We're taking that apart right now. That's a shame, and it's going to put that guy who wants to buy beer in Texas at risk for his job and his house and everything else.
Gentleman from Texas.
Reserve.
Gentleman reserves. Gentlelady from California.
I yield to Representative DeLauro, the gentlelady from Connecticut, a minute and a half.
Gentlelady from Connecticut is recognized for 1 1/2 minutes.
I stand in strong opposition to this bill, which weakens Dodd-Frank, those regulations over derivatives markets. It allows foreign banks and swap traders to engage in the same risky behavior that caused an economic meltdown a few short years ago. We are here to represent the American people, not the big banks. And after the 2008 financial crisis that triggered the worst recession since the Great Depression, the American people want to see more accountability from Wall Street, not less. That's why we passed Dodd-Frank in the first place, to end dangerous speculation by financial institutions and prevent more bailouts. The bill before us tries to exempt from oversight any swap transaction in which one of the parties is not based in the U.S. In other words, it effectively guts the derivatives regulations in the Dodd-Frank Act. When AIG nearly destroyed the economy, their affiliate was based out of London as a branch of a French-registered bank. Lehman Brothers had 3,300 legal entities here and abroad when it failed. Citigroup set up numerous structured investment vehicles overseas to move positions off of its balance sheet. But when those investments were about to fail, Citigroup in the U.S. assumed the huge debt and was ultimately bailed out by U.S. taxpayers. The notion that we should let big banks evade Dodd-Frank oversight if they set up a subsidiary in another major economy first is absurd. A vote for this bill is a vote for more risky derivatives transactions, more bad behavior, more bailouts. I urge my colleagues to stand up for the American people, the American taxpayers, and vote this down.
Gentleman from Texas.
Reserve.
Gentleman reserves. Gentlelady from California.
I yield to the gentleman from Massachusetts an additional minute. Mr. Capuano.
Gentleman from Massachusetts is recognized for 1 minute.
Thank you, Mr. Speaker. Thank you, Madam Chair. What this bill says is that if you do this activity in the United States of America, you will be subject to certain regulations. If you do the exact same activity through a subsidiary in a foreign country, you will not be subject to our regulation. That's an open invitation to move American jobs offshore. It's an encouragement to move American jobs offshore. It is blatantly obvious. How is that good for the American economy? I don't know. Why would we want to say to any American company, some foreign regulator is better than us? Now, I know we're going to have this debate in other matters later on this week, saying just the opposite. So in this case, foreign regulators are better, but in other cases, they're not. Kind of stunning. We actually did it this morning on another matter. I want to join with the AFL-CIO in making a pretty clear warning to my colleagues. If this bill becomes law, I regretfully agree that there will come a day that you will regret this vote, as many of us, not me, but many of us, regret the vote for the Patriot Act.
Gentleman from Texas.
Reserve.
Reserves. Gentlelady from California.
I yield to the gentleman from Massachusetts an additional 1 minute.
Gentleman from Massachusetts is recognized for 1 minute.
Thank you, Mr. Speaker, and I thank the gentlelady for yielding. Let me just make one final point on this. What this bill will do now is to give the Cayman Islands or London or some other jurisdiction the ability to write derivatives rules that cover U.S. Affiliates. Now, the problem with that very idea is that the Cayman Islands or any other jurisdiction has no interest in protecting the U.S. taxpayer. That's the truth. When the bailout for AIG came, it was $160 billion in U.S. currency supported by the U.S. taxpayer that bailed AIG out. So any of these foreign affiliates that go under in foreign jurisdictions, those foreign jurisdictions, whether it be the Cayman Islands or any other jurisdiction, have no interest. They have no dog in the fight to protect the American taxpayer. That's the problem with this bill. That's the bottom line. We should vote against it. This is a disgrace. But it does show the power of Wall Street. I'll say that.
Gentleman from Texas.
I yield myself 15 seconds, Mr. Speaker, to say, one, if this is a disgrace, you need to inform almost two-thirds of your members who voted for it in committee. Second of all, nothing in this amends Dodd-Frank. Third of all, you all tell us Dodd-Frank ended too big to fail, so the specter of bailout, I simply do not understand. You need to make up your mind. We reserve.
Gentlelady from California.
I yield to myself as much time as I may consume to
Gentlelady's
refute.
recognized.
The gentleman from Texas keeps talking about we make the claim that we ended too big to fail. That's what we're trying to do. That's what we're standing up against, what you're attempting to do in this piece of legislation. Derivatives are an important part of the reform of Dodd-Frank. It is important because we're trying to create transparency. The over-the-counter derivatives market that has been working for so long in the shadows, we cannot continue to have. I'll yield to the gentleman from Texas.
If I misquoted the gentlelady, I apologize, but I had thought I had seen earlier quotes where the gentlelady posited that Dodd-Frank ended too big to fail. If I was incorrect, I apologize to the gentlelady, but I thought she had said that on more than one occasion.
Reclaiming my time, the gentleman from Texas knows how it works. We have Dodd-Frank reform, and it has to be implemented. You know the living wills have to be done. You know that we have to put in place all that it takes to have the orderly